Welcome to the deep dive. Forget scrolling through endless articles. We take that stack of information you've shared and pull out the most interesting, surprising, and important insights just for you.
Yeah, it's about cutting straight to the core, understanding not just what's in the source material, but what it really means.
Exactly. And today, we're doing a deep dive into the world of investment research. Specifically, we're cracking open a high-conviction ideas list from CMBI Research.
Okay, so the sources for this deep dive are CMBI's research focus list from January 16th, 2025. Then there's a detailed update on NetEase from February 21st, 2025, also from CMBI.
Right.
And finally, a market beat report summarizing NetEase analyst ratings and market data as of June 11th, 2025.
So our mission here is to unpack what makes these companies stand out to the analysts, find those surprising nuggets maybe buried in the reports, and understand the bigger picture implications for you. Let's jump right into that first source, the CMBI focus list from January 16th.
Okay, let's unpack this list first. CMBI labels it our best high-conviction ideas, which, signals they're putting their strongest recommendations here. It's not just a random collection.
And they actually show you their homework. I found that interesting. They track how well their previous lists performed. The list from back in November 2024, I think it had 21 stocks. It actually outperformed the broader market index, the MSCI China Index, over the next couple of months.
That's right. Over that period, November 19th, 2024 to January 15th, 2025, that previous list, if you had put an equal amount of money into each stock, it returned, I'm going to say, 0.8%.
Okay.
Now, the MSCI China Index, the benchmark they used, returned negative 4.3% in the same time frame. So that's a significant outperformance, 3.5 percentage points in, less than 2 months.
Yeah, that's pretty good. And here's where it gets really interesting to me. Within that previous list of 21 stocks, 4 of them delivered a return of 18% or more during that short period. And 8 of the 21 stocks outperformed the benchmark index. So, not everything was a home run, obviously, but the list as a whole seemed to deliver value relative to the market.
And the list covers both long ideas, which means they recommend buying the stock, expecting it to go up, and also short ideas, where they think the price will fall. For this deep dive, though, we're focusing purely on the long ideas, the ones they were bullish on.
Makes sense. It's also fascinating to see that these lists aren't static, right? They make changes. They mentioned removing a few stocks from their previous list for specific reasons. Li Auto, for example, was taken off.
Yeah, for Li Auto, it was because the analysts didn't see clear catalysts, specific events or news that would drive the stock price up in the first half of 2025. They were kind of waiting for more information about Li Auto's battery electric vehicles.
Okay, waiting for news.
And for the apparel companies like Bow Siding and JNBY, the caution was surprisingly tactical. While they still had confidence in the long-term demand, they were worried about near-term sales because of a warmer-than-expected winter.
Warmer winter.
Yeah, and an early Chinese New Year in 2025. It really highlights how detailed this kind of analysis gets, doesn't it? Considering things like seasonal weather patterns affecting clothing sales.
Wow. Yeah, thinking about warmer winters impacting investor sentiment is a great reminder that research goes deep into these operational details. So, okay. Let's dig into some of the specific long ideas from this January 16th report and understand why the analysts were excited about them. We can start in the auto sector with Geely Automobile, stock code 175HK. The report kicks off with a pretty provocative question. Will 2025 be a replica of 2016 for Geely?
That's a bold way to frame it, isn't it? Suggesting a potential breakout year. Their bullish case really hinges on Geely's new technological foundation, this GEA platform, and their EMI hybrid technology. The analysts project these will fuel a huge surge in new energy vehicle, or NEV, sales.
How big of a surge are we talking about here?
But they're projecting a 50% year-over-year rise, 50%, to 1.31 million NEV units in their fiscal year 2025 estimates. That's what FY25E means. And if they hit that number, NEVs would make up 55% of Geely's total projected sales. That's a massive shift in their sales mix.
50% growth in NEVs is huge. And I think the report also mentioned cost reductions.
Yes, absolutely. They estimate Geely could reduce the bill of materials, basically the cost of the parts going into each car, by RMB 5,000 to 7,000 per vehicle.
Per car.
Per car. And this reduction comes from simplifying their platforms and their hybrid architecture, which, can flow directly to their bottom line.
That sounds like a double win then. More sales of these higher tech vehicles and lower costs to build them. What else makes them think 2025 could echo 2016? You mentioned that parallel.
Yeah, this is the historical angle they drew. Geely is integrating several of its brands, combining Zeekr with Lynk & Co. and Geometry with Galaxy.
Oh.
Analysts point out they did a similar brand realignment way back in 2014, and that move preceded significant sales surges in the following years, from FY15 through FY17. So they're kind of betting on history repeating itself here, maybe due to improved brand focus and synergy.
Okay, so new tech, lower costs, brand integration, echoing a past success. How does this all translate financially in their projections?
Well, they project Geely's core net profit to rise 36% year over year in FY25E. And another small but telling detail they included: share purchases by the company chairman and management.
Ah, insider buying.
Exactly. It's often seen by analysts as a signal that those close to the company have personal conviction in its future prospects, putting their own money where their mouth is, so to speak.
That makes sense. Management putting their own skin in the game. Okay, staying in the auto sector, let's look at XPeng Inc. That's XPEVUS. What was the angle here?
For XPeng, the strategy highlighted in the report focuses on launching more cost-effective models, things like the Mona MO3 and the P7 Plus facelift.
Right.
Now, this isn't just about selling cheaper cars, it's about reaching a wider market segment and gathering data on what these value-conscious customers really want. This strategy is then informing the 4 new models they have planned for 2025, including their first EREV, an extended-range electric vehicle.
And the report mentioned sales volume was improving in late 2024.
Yes, the sales data from Oknov 2024 suggested they were getting a better handle on supply chain management, which is always crucial for hitting production targets. But the real story the analysts emphasize for XPeng is their potential path towards profitability.
Yeah, profitability.
Right.
Yeah, that's the holy grail for many EV makers still. How do they see XPeng getting there?
It's sort of a two-part story. First, gross margins. Analysts estimate that these new cost-effective models and the P7 Plus facelift will achieve gross margins exceeding 10%.
Okay, over 10%.
Yeah, and gross margin is basically revenue minus the direct costs of making the product. Getting that over 10% for these key models is a really important step. They project this will lift XPeng's overall growth margin to 15.1% in FY25E.
Okay, so making more profit per car sold. What's the second part?
Driving down operating expenses relative to revenue. SG&A, selling, general and administrative costs, and R&D, research and development, are big costs for tech companies like XPeng. The analysts expect these costs as a percentage of revenue to fall sharply. They're forecasting from 32.6% in FY24E down to 21% in FY25E. That suggests some significant efficiency gains beyond just manufacturing.
Right, cutting overhead and R&D is a share of sales. So cutting costs and improving margins.
Yep.
What does that mean for the bottom line then?
This leads the analysts to project a narrowed net loss in FY25E and, crucially, potential profitability in FY26E.
That's the target.
That's the target. They do note that their target valuation for XPeng, 1.5 times its projected FY25E sales. That's the PS, price-to-sales ratio, not PE here, which is an important distinction for growth companies.
Right, valuing based on sales.
Yes, they acknowledge that 1.5x PS target is higher than some peers, but they justify this premium by pointing to XPeng's forecast of faster sales growth and that potential to reach break-even sooner than others might.
Interesting, valuing them more on that sales growth trajectory and the path to profit rather than just current earnings. Okay, shifting gears completely now, let's look at China Hongqiao, 1378 HK, in capital goods. What makes an aluminum producer a high-conviction idea? Seems a bit different.
Well, this company is seen as a direct beneficiary of market fundamentals. The report highlights a tight global aluminum supply environment.
Why is supply tight? What's causing that?
2 main reasons cited. First, capacity controls in China government policies limiting how much aluminum can actually be produced. Second, disruptions in bauxite supply, which is the raw ore needed to make aluminum.
Okay, supply constraints.
Exactly. And on top of that, demand is rising from growth areas like EVs, solar power installations, and even a stabilizing construction sector in China. So you have tight supply plus rising demand. That's usually pretty good for prices and for producers.
And China Hongqiao is a major player in this market, right?
Yeah. Yes, they have about 9% global market share in aluminum output, which is significant. The report expects them to benefit from expanding profit margins, largely due to their vertically integrated model.
What does vertically integrated mean for them specifically? How does that help?
It means they control more of the production process from start to finish. For Honkyo, this includes having interests in overseas bauxite mines so they control some raw material input. They also own their own captive power plant.
Ah, power is huge for aluminum.
It's a massive cost, so having their own cheap electricity is a big advantage. And they produce a high percentage of molten aluminum products, which can be more efficient. This integration likely gives them much better cost control compared to companies that have to buy raw materials or power from outside suppliers.
Yeah, owning their own power source must be a significant competitive advantage. Okay, let's move into consumer discretionary, starting with Luckin Coffee, LKNCYUS. They've grown incredibly fast, haven't they?
They certainly have. The report positions Luckin as the largest and fastest growing coffee brand in China. They cited some pretty impressive numbers from FY23. 16,248 stores.
16,000.
Yeah, RMB 24.9 billion in sales and RMB 2.85 billion in net profit, giving them something like a 21.7% market share.
Wow. What are the key drivers the analysts pointed to for continued growth? Is it just opening more stores?
Well, rapid store expansion continues to be key, yes. But they also highlighted increasing average spending per customer. That's fueled by new product launches, wider adoption of freshly made coffee versus, say, instant coffee, and higher purchase frequency.
Getting people to buy more often.
Exactly. And this seems particularly true among younger, wealthier customers, and also those in lower-tier cities where Luckin has established a really strong presence.
It sounds like they're firing on multiple cylinders
That's
than
right.
getting more customers and getting existing customers to spend more. What about the competitive environment? I remember hearing a lot about fierce price wars in Chinese coffee.
Yeah, the report specifically addresses this. Analysts expect the decline in same-store sales growth seen previously to narrow in the fourth quarter of 24 and actually turn positive again in FY25E.
Turn positive. Why?
They think competition is easing up a bit. They specifically mention a competitor, Kadi, halting its expansion, and that the really intense price war seems to be fading.
Okay, so maybe less discounting pressure, combined with their product innovation and efficiency.
Exactly. Innovative products, lower costs per cup, probably due to their scale and supply chain advantages, and improved operating margins from stricter staff requirements and just better efficiency. All these are expected to contribute to positive same-store sales growth again.
Makes sense.
Interestingly, the analysts are actually more optimistic than the street, meaning the general consensus among analysts on Luckin's sales growth, but they're slightly more conservative on margins. They describe the stock as undemanding at 15 times their FY25E projected earnings.
15 times earnings, the PE ratio.
Right, the price-to-earnings ratio. How much investors are willing to pay for each dollar of expected future earnings? They see 15x as attractive given Luckin's leadership position in costs, branding, and their digital strategy.
15 times expected earnings seems pretty reasonable for a fast-growing market leader, yeah.
Yeah.
Okay, also in consumer discretionary, Yum China, 9987HK. This is the company behind KFC and Pizza Hut in China. How does a more established player like this fit into a high-conviction list?
Well, Yum China is seen as a beneficiary of the post-pandemic environment, but maybe more through resilience and market share gains rather than just purely rapid growth like Luckin. They're really focused on improving margins through various operational strategies.
What kind of strategies are we talking about?
The report points to things like innovative products, increased automation in their stores, opening smaller, more efficient store formats, and also lower capital expenditure.
Lower CapEx, meaning less spending on new assets.
Right, which can lead to less depreciation expense hitting the income statement and potentially better free cash flow.
So basically making the existing business more efficient and profitable. Did they mention same-store sales for Yum?
Yes, they noted that same-store sales growth might have actually been negative in the fourth quarter of 24, even with more customer traffic. However, net profit growth was still expected to be decent.
How? If sales per store were down?
Thanks mainly to lower raw material inflation food costs coming down and those efficiency gains we just talked about.
Ah, okay. So lower food costs and running leaner operations was key. What about the outlook for 2025 then?
The outlook for FY25E was described as cautiously optimistic. They cited a potential reduction in competition, similar to the coffee space, and specific strategies for their main brands. For example, KFC implemented a slight price hike, which the analysts didn't expect to deter its value-focused customers.
Okay.
Pizza Hut, on the other hand, significantly cut prices on about 30 items, presumably to boost traffic. So different pricing tactics for different brands.
Interesting contrast.
Yeah, and they also highlighted expansion plans for their K-Coffee concept within KFC stores and these smaller format WW stores.
Different strategies for different brands make sense. How did the analysts view the valuation for Yum China?
Similar to Luckin, actually. The analysts were more conservative on sales forecasts than the consensus, but they were more confident on the margin outlook. They described the stock as highly attractive,
Highly attractive. Why?
partly due to a generous cash return program for shareholders' dividends and buybacks. They calculated this was equivalent to about 9% of the stock's market cap at the time.
9% return just from cash back to shareholders.
Yeah, returning that much cash is often seen as a strong sign of financial health and management's commitment to shareholders. It's a big number.
That is significant. Okay, moving to healthcare now. Bay 1, ONC US. The report called this an inflection point. What did they mean by that?
The key here is the company's financial trajectory, specifically its move towards profitability. They were aiming for GAAP operating income break-even in FY25.
GAAP break-even. What's the difference between GAAP and non-GAAP again?
Right, so GAAP, generally accepted accounting principles, is the standard accounting method. It includes all expenses like stock-based compensation. Non-GAAP often excludes certain non-cash or one-time items to try and give a clearer picture of the core operating performance.
Okay.
And Beyond had actually already achieved non-GAAP operating profitability for the second consecutive quarter back in 3Q24. So that was a positive sign for their underlying business model, even before hitting full GAAP profitability.
So they were already profitable on that sort of stripped-down basis and
Yeah.
targeting full GAAP profitability soon. What was the big milestone mentioned in the report?
Generating positive quarterly operating cash flow for the first time ever in 3Q24, they reported US $188 million.
Positive cash flow.
Yeah, cash flow is king, right? It shows the business is actually generating more cash from its operations than it's spending. Reaching positive operating cash flow for the first time is a really significant financial milestone and a core part of the investment thesis here. It demonstrates improving financial health and sustainability.
That positive cash flow number is definitely something investors look for. Okay, finally, in the insurance sector, PICC P&C 2328 HK. What was the angle on this property and casualty insurer?
Here, the analysts specifically addressed some investor concerns. There had apparently been high losses in non-auto insurance claims back in 3Q24.
Right.
The analysts' view was that the peak of the combined ratio for those non-auto claims had likely passed, and that this negative news was probably already reflected or priced in to the stock price.
What is a combined ratio exactly?
Think of it like an insurer's operational efficiency score. It's the ratio of their claims paid out plus their expenses divided by the premiums they collected. A combined ratio below 100% means they're making a profit from their core insurance underwriting before considering any investment income.
So lower is better.
Lower is better. A ratio above 100% means they're losing money on underwriting. So saying the peak combined ratio likely passed means they expect those non-auto losses to improve, bringing the ratio down.
Okay, so expectations for improving profitability on the non-auto side. What about their auto insurance business?
They expected auto premiums to recover in FY24E. They linked this partly to a government trade-in policy designed to boost new car sales, which naturally drives demand for new auto insurance policies. Overall, they projected the company's total combined ratio to improve in FY25E, meaning better underwriting profitability across the board.
And did they discuss dividends for PICC P&C?
Yes, and this was an interesting detail. Insurers often link their dividends to their net income with a target payout ratio, the percentage of earnings paid out as dividends. P&C usually targets over 40%.
Okay.
But the analysts thought that because the third quarter's bottom line was actually strong financially, despite those non-auto losses, the company might choose to focus on growing the absolute amount of the dividend per share in FY24E rather than strictly sticking to that payout ratio percentage based on potentially volatile earnings.
Focusing on the dollar amount of the dividend, making it more predictable perhaps rather than just a percentage of earnings. Did they project attractive dividend yields then?
Yes, they projected yields of over 5% for both FY24E and FY25E, which is generally seen as pretty attractive, especially for a more defensive stock like an insurer. They basically saw value in its improving underwriting results and its role as a more stable investment compared to some of the growth stocks we've discussed.
So wow, we've covered quite a range of companies from that January high conviction list. We looked at the specific details the analysts zeroed in on, everything from new tech platforms and cost structures to market share dynamics, financial health milestones, even government policies, and the weather.
It really gives you a flavor of the diverse factors that go into these investment recommendations, doesn't it? It's not just one thing.
Definitely. Now let's shift our focus a bit and zoom in on NetEase, stock ticker NTESUS. This is an internet company that was on that January list, but where we also have more recent research available, which allows us to kind of layer the analysis over time.
Right. So in that initial January 16th report, NetEase had a BUY rating with a target price of US $125.50. The analyst noted back then it was trading at what they considered a 2-year low price-to-earnings ratio, about 13 times their FY25 earnings estimate.
13 times PE.
Yeah, suggesting the stock might be undervalued relative to its future profit potential, even though there were some short-term market challenges at the time.
And the expected catalysts, the things supposed to drive the stock price back then, were the launches of new games, right?
Mm-hmm.
Specifically Marvel Rivals and Where Winds Meet.
Exactly. Those were the big anticipated launches. Now let's fast forward to the February 21st, 2025 update. This came out after NetEase reported its fourth quarter 2024 results, and total revenue for that quarter was actually slightly down year over year by 1.4%.
Okay, so flat to slightly down revenue, not great. But the report mentioned something positive about profit, didn't it?
Yes, this is a surprising nugget here, maybe the key takeaway. Operating profit actually grew by 13.9% year over year in 4Q24, and it was 8% ahead of the consensus estimates.
Wow, profit up almost 14%, even with revenue down. How?
Primarily due to, and this was clearly highlighted, prudent control of sales and marketing expenses. Those were down a significant 33% year over year in that quarter.
33% cut in S&M. That's huge. That really flowed through to the bottom line then. So for the full year 2024, how did they end up?
For the full year 2024, revenue grew just a modest 2%, but operating profit grew a much healthier 7%. This really highlights an important insight, I think. Companies can improve profitability even if top-line revenue growth slows down by focusing intensely on costs. NetEase's expense management wasn't just trimming, it fundamentally shifted their profit trajectory despite softer revenue.
That focus on the bottom line clearly impressed the analysts. Looking ahead from that February report, did they still see games as the main driver for NetEase?
Absolutely. The February report still expected those new games like Marvel Rivals and Where Winds Meet to drive a re-acceleration of games revenue growth in FY25E. This suggests that maybe initial results, or at least their confidence, remained high even after seeing the Q4 numbers.
And were there other game launches planned that they mentioned?
Yes, they mentioned several other highly anticipated global launches planned for FY25E. Names like Fragpunk, Destiny, Rising, and Marvel Mystic Mayhem were listed.
More Marvel games.
Yeah. And these launches aren't just about growth. They're expected to help NetEase diversify its game portfolio across different genres and also expand its global reach beyond just China.
What about their other business segments? Because NetEase isn't just gaming, right? They have music, education.
Right. The February report noted that cloud music revenue declined slightly in 4Q24, and their Udao education and innovative businesses saw larger year-over-year declines. The company's explanation, according to the report, was that they were focusing on quality growth and prioritizing higher return on investment in those areas.
So basically pulling back from less profitable activities to focus resources where they could get better returns, even if it meant less revenue initially in those segments.
Precisely. It shows a disciplined approach across the board, cutting marketing costs heavily in gaming, prioritizing profitable initiatives elsewhere. This prudent expense control, as we discussed, led to that improved operating profit margin in 4Q24, and the analysts expected this cautious approach to continue supporting margin improvement into FY25E as well.
Makes sense.
They also highlighted a really significant level of shareholder return in FY24. They totaled RMB 20.0 billion through dividends and share buybacks.
20 billion RMB. How significant is that in context?
Well, the report calculated it was equivalent to roughly 67% of their net income for the year. 67%, and about 4% of the company's market cap at the time. Returning that much capital to shareholders is a strong signal of financial health and management's confidence in future cash flow.
Definitely.
So based on these updated forecasts, which actually involve slightly lower revenue projections but higher net income estimates because of that cost control, CMBI reiterated their BUY rating and kept that US $125.50 target price from January.
Okay, so CMBI maintained their bullish view and the same price target, even with the updated, maybe mixed results.
Yeah.
Now let's add the final layer from that market beat report, which gives us a compilation of what other analysts were thinking and, crucially, where the stock price actually was on June 11th, 2025.
Right. So as of that date, June 11th, the market beat report compiled ratings from 8 different analyst firms. It showed a consensus rating of moderate buy.
Moderate buy. How did that break down?
That consensus was based on 7 firms having a buy equivalent rating and just 1 having a hold rating.
No.
So the general sentiment among that group of analysts was still positive.
Okay, still generally positive. What was the average price target among those analysts?
The average one-year price objective among the analysts who had issued reports in the preceding year was US $119.38 average.
$119.38 average.
Yeah. And the report listed specific targets from several firms, too, giving a sense of the range. For instance, Deutsche Bank was at $130 with a buy, Morgan Stanley at $117 overweight, Barclays $118 equal weight, Benchmark $115 buy, and JP Morgan Chase & Co. was highest at $135 overweight.
Okay, so a bit of a range there, but mostly clustered around the $115 to $135 mark. And where was the NetEase stock actually trading on that day, June 11th?
On that date, NetEase shares closed at $132.97.
$132.97. That's fascinating. The actual stock price on June 11th was trading above both the average analyst target of $119.38 and even CMBI's specific target of $125.50 from their February report.
Yes, exactly. Which
Right.
immediately raises the question, right? Had the stock maybe already moved beyond what many analysts expected, perhaps due to those game launches panning out well or continued cost discipline? Or were the analyst targets potentially lagging the stock's actual performance and the company's improvements?
Good question.
The Market Beat report also provided some context like moving averages. The 50-day moving average was around $110.07, and the 200-day was $102.15. Both being well below the current price showed the stock had been trending upwards pretty strongly recently.
Right, those rising moving averages confirm that positive price momentum leading up to June. What other useful bits of information did that June Market Beat report provide?
It gave us some key valuation metrics as of June 11th. NetEase had a market cap of $84.25 billion, so a large company. Its PE ratio was 20.87, the PEG ratio was 3.37, and the beta was 0.67.
Okay, can you unpack those numbers quickly? What do they tell us?
Sure. A PE of 20.87 means investors were willing to pay about 20.87 cents for every dollar of NetEase's trailing 12-month earnings at that point. The PEG ratio compares the PE to the earnings growth rate. A higher number, like 3.37, can sometimes suggest the stock might be a bit pricey relative to its expected growth, though interpretations vary. And a beta of 0.67 suggests the stock is less volatile than the overall market. A beta of 1 means it moves in line with the market. Less than 1 means less volatile.
So less volatile than the market, but maybe trading at a valuation that assumed continued strong growth.
Right.
What about that dividend you mentioned earlier? Did Market Beat have details?
Yes, the Market Beat report noted they had announced a quarterly dividend of 0.6755 per share. If you annualize that, it's $2.70 per share for the year. Based on the $132.97 purchase price, that gave a dividend yield of 2.03%.
Okay, about a 2% yield.
Right, and their payout ratio was 38.71%, meaning they were paying out just under 40% of their earnings as dividends, retaining the rest for growth or other purposes. The report also mentioned that institutional investors held 11.07% of the stock at that time.
That's a lot of specific data points coming together there.
It is. But each piece gives you a slightly different angle, right? The market cap tells you its size, the ratios give valuation context, the beta suggests its risk level relative to the market, the dividend shows the cash return aspect, and institutional ownership can indicate confidence from large professional investors.
So we've really come full circle here. We started with that CMBI high conviction list from January 2025, exploring the detailed analysis behind several companies across quite different sectors: autos, manufacturing, consumer names, insurance, tech.
And then we really zoomed in on NetEase, layering on that more recent analysis from February, which confirmed the importance of game launches, but really highlighted the significant impact of that prudent cost control. And then we added the Market Beat snapshot from June, showing where the stock price stood relative to analyst expectations and providing that key market data context.
Yeah, this deep dive really gives you a detailed snapshot, I think, of how investment research firms identify potential opportunities and how different reports over time can build a layered understanding, even for a single company. We saw them highlighting very specific details, things like new product platforms, operational efficiencies, market share battles, government policies, financial health milestones like hitting profitability or positive cash flow.
It really underscores that successful investing often comes down to digging into these specific drivers, doesn't it? It's not just about looking at the headlines or the broad sector trends.
Absolutely. Which brings us to an important question for you as you think about everything we've covered today. Considering this wide range of factors and specific details, the analysts highlighted across all these different companies, everything from cost structures and market share fights to new game releases, brand strategies, specific financial ratios, changing consumer behavior. What single metric or theme discussed today do you think is the most powerful indicator of a company's potential success in the current market environment? Is it margin expansion, market share gains, technological innovation, something else?
Yeah, that's a great question. Definitely something to mull over as you continue your own analysis and thinking.